Hello, so welcome back to MYOD Podcast, the podcast that inspires you to shape your future. Today we have a very special topic, the topic of investing. As you guys know, I love investing, and it's the topic that I'm always fascinated about. Investing, I always say that it's like a magic trick whereby you put a rabbit into a hat and you expect two rabbits to come out. But sometimes you might put a rabbit and you'll find that there's no rabbit that's coming out, and that is investing. And investing is very important for everyone. Whoever you are, you must know how to invest, because if you're not investing, that means you're saving. And as we all know that saving equals losing. There are a lot of factors that can make you lose money just by saving. Money has to move, money has to be invested, and investing by itself is a skill that if you know, you can make a lot of money, and if you don't have the skills, that means you can lose a lot of money. And today we have a very special guest that is an investment expert. So we have Mr. Salum Awadh. He is an accomplished entrepreneur, investor, corporate advisor, speaker, author, and an investment banker. Mr. Salum is the founder of Shirkah Asset Management and the CEO of SSC Capital, where he has been at the forefront of transforming Tanzania financial and investment landscape. He is also passionate advocate for SMEs, which are small and medium enterprises, a champion for venture capital, and a visionary in shaping the future of finance in East Africa. So get ready for an insightful conversation on business, finance, and making your own destiny. As always, before we start, if you like these topics and if you like guests like this who come here and share value to you guys for free, please subscribe and like this video. Mr. Salum, how are you doing?
I'm good. Thanks to be here.
You're welcome.
Thank you very much. Alhamdulillah.
I always love when guests come here before time.
Oh, nice. Yeah, so that's what I usually do.
How was the journey to the studio?
No, it was okay. My initial thinking was different. I thought it was much far than what I thought, but coming here was easy, straightforward, and alhamdulillah, I got here on time.
For those who don't know you, can you explain a bit of a background and how did you get here?
Yes, I mean in the studio or in my career?
In your career in the studio as well.
Yeah, so as you rightly put it, and appreciate your introduction, it goes back probably 20 years. You see gray hair. I'm not as young as you. So when I went for my first degree at the university, I didn't have a lot in terms of interest, if I may, in finance and investment. Okay. My interest was pretty much more on interest in development stuff, because I always want to do things such as work in the development space, impacts, community work. That was my drive then, and that was my interest then. And then I did my first degree, and then I went to work. I was employed. I did some work here and there. And then when I did my second degree, that's when, of course, just before that, I worked for a pension fund. And that's when I was exposed to the whole world of finance and investment to some degree. And then I developed a lot of interest for that matter. So since then, it's been finance all around. And that, of course, put me into starting the firm, SSC Capital, which you just mentioned, which now purely focuses on matters related to finance and investment. And for me to be, have authority to talk about investment and finance in the public, and of course in private with clients, okay, I had to do a lot of certifications and going back to do a lot of studies around that. So, in combination of all that, okay, that's put me where I am today professionally in terms of finance and investment, but career-wise in terms of what I do for my living.
I'm wondering what inspired you to get into finance?
I think it's the whole scenario about how finance works in terms of stimulating economic development of a country. Because what I believe is for a country to prosper, You can do everything. You can educate people, which is the most important thing if you ask me. You can do these all other things. But at the end of the day, you need to invest. You invest in people, you invest in infrastructure, you invest in healthcare, you invest in all the kind of stuff. And that's where finance becomes pivot in terms of making sure that all these things happen. That's number one. So finance, for me, drew that interest because it's something which is critical for any country's development. And if you're at the center of it, we have huge impact for a country's development. Number one. Number two, I'm quite an advocate when it comes to uplifting people's lives through economic mechanisms, economic schemes. So I'm a strong believer that if you want to lift people out of poverty, if you want to empower people, you must build economic systems which are beneficial to these people. And one of them is to help people start their own businesses. Because I think, they start about youth, 1 million youth into the labor market every year. And less than 20% of these guys get jobs. So there are no jobs, and there'll be no enough jobs, at least in the next 10, 15 years. If you look at the economy of Tanzania, a number of people that are produced to the labor market every year. So we need to find ways to support these people to become entrepreneurs. And one of the critical challenges, among others, is access to finance. So I felt like maybe there's something we can do in terms of bringing finance. You mentioned about venture capital, all these kind of funding schemes to help people start and grow their businesses. Because I believe if you can empower one youth entrepreneur, most likely this guy will also employ 3-4 other young people. And that's how you can address youth unemployment. But lastly, at an individual level, I'm sure you want to live well with your family. You want to take care of your family. You want to retire well. And that, of course, needs you to do certain things for you to have that kind of lifestyle. That will include, of course, saving some of the money that you make and investing what you're saving, which I think we'll talk about that. So all that needs people to support other people to do these things, to advise them, to manage their investments, and make sure that we build wealth for everyone in Tanzania and across Africa. So those three things, for me, drew a lot of interest and attention to finance.
So as I said previously, that I also did finance and banking, but I did it for 4 years in Turkey. But whenever I talk about finances and investing in this podcast, I always add a disclaimer that this is not financial advice. That people should go and do their own research, or should go and consult their financial advisors, because they don't pay me to be the financial advisor, and I'm not their financial advisor. So I always talk about my experiences on how I invest my money by myself, with hope that people can learn from my experiences. But it's strictly not financial advice. But you are a certified financial advisor. So how does someone become certified?
So in Tanzanian market, we don't have there are two things here. There are two levels of financial advice. So if you go to the public and you want to be an investment advisor, where you can advise the public, then you need to be certified by the Capital Markets Authority in Tanzania. So there's a process where you apply at company level, as if you have a company that wants to offer such services, then you have to be licensed, basically, not necessarily certified for that matter. Number one. Number two, if you want to train people on matters related to finance, then BOT has also established now some sort of training certification for people to become certified financial educators, called CFA. If you want to be that. Other than that, you just have to undergo yourself through a number of professional courses which are known in the market, that will give you all the necessary skills and knowledge to advise people. So you may be a CPA, you may be a CFA, you may do a ACCA, you may do CIJA, like what I did, which is a global investment analyst, which gives me the opportunity to work in any part of the world as an investment expert, not necessarily limited by geographical boundaries. So it comes down to that. Because at the end of the day, one thing is to be certified, but the other thing is to provide the right advice to people. And the right advice you can give to people is based on two things. Number one is the knowledge that you have. Number two is experience, the time that you have taken to learn. Because as you said yourself, people can learn from the things that you do, not necessarily from the things that you learned, because you are yet to be certified financial advisor. But learning is the most part, actually, less than learning. Experience is the most important part. So that's how you become a financial advisor, at least in Tanzanian context.
Putting that out of the way, because I just wanted to let the people know that today we have a licensed financial advisor. So whatever advice is coming today it is financial advice. So as I said before, a lot of our viewers are young people from the ages of 21 to 35. That's more than 70% of our viewers. So, and most of these people are beginners. They don't really know how to invest. So for beginners right now here in Tanzania, what investments would you advise them to put their money in?
So that's where we draw the line now between advising people and talking about investing. So this is one thing that people need to understand is you don't tell people what to invest in. So that's the one thing that you do wrongly. That I see people tell other people, invest in stocks, invest in Bitcoin, invest in bonds and all that kind of stuff. Because investing is the final part of the process that someone needs to go through to start investing. So before you start investing, there are things that we need to know about you. So if you pick, let's say you want to invest in stocks, which maybe we can talk about, if you want to invest in bonds, if you want to invest in real estate, that comes down to a lot of things. Number one, your age. So age determines where you invest your money. So you don't tell people where to invest without knowing their age groups. The younger you are, the more risk you can take, the more risky investment you can do. The older you get, the less risky you take, the less risky investment you're supposed to do. That's number one. So number two is why are you investing? What do you want to achieve out of investing? What we call financial objectives. So the second thing that you need to know about the person that you want to advise where to invest. So this is important. I say this because I see people on social media telling people, invest here, invest there. Of course, you can give very general advice. It's okay. But specifically, these are things that you need to know. So you want to invest because, number one, maybe you want to plan for your retirement. Number two, maybe you want to buy a new car. Number three, maybe you want to buy a new house. Number three, maybe you're Muslim, you want to go for Hajj. And number four, maybe you're someone that you want to buy another house, maybe for investing, not necessarily for your own residence. All these different financial objectives will determine what types of investments you will do. And in relation to your age, you may be, let's say you want to invest to grow your portfolio. So we call this growth investors. So you want to, I want to put, like I say, you put one rabbit, you expect two rabbits coming out. So you have doubled your investment. So this is growth investing, which is risky, but you cannot do that for someone who, let's say, who's 50 years and above, because they might, they can lose the rabbit for that matter, because that's a very risky investment. So it comes down to that. Once you know all those dynamics, and of course, other things like, are you a regular investor or one-off investor? You say you invest yourself. So you have someone who you only invest erratically, maybe when you get some money, maybe once a quarter or once a year, and then you put your money in investments. The way you advise that person is different from someone who invests regularly every month. So you have people, let's say you're on a salary, and then we say, okay, maybe you can put aside 20% of your salary, which we can take the money and invest for you. So if someone is doing that monthly, the way you advise them to invest their money is different from someone who's a one-off. Because someone who does regularly is easy to put some types of investments which can compound, because not all investments can easily compound. So it's like that. So once you know all that, that's when you can advise people where to invest. So there are so many types of investing. So the most popular are stocks. You can invest in stocks. And there are two types of stocks, or rather shares, if you want to invest in. You can buy shares of a company which is private. So let's say your podcast, you decide to sell some shares to some investor so someone can invest in you.
Yeah.
Or you buy shares of a company which is listed in the stock market. So that's another way for you to buy shares. In Tanzania, we have 28 companies which are listed and trading the Islam Stock Exchange. So you can buy stocks. We can talk about what is a stock, how does it work. Number one. Number two, you can invest in what we call fixed income securities. So these are types of investments which are less riskier than stocks, give you some sort of guaranteed return within a fixed period of time. So this could be bonds, and bonds are also classified. There are bonds which are issued by the government, which we call treasury bonds. There are bonds which are issued by companies, which are called corporate bonds. There are bonds which are issued by municipal authorities, maybe to finance some municipal projects, we call municipal projects. There are bonds which are issued by countries in international markets, we call Euro bonds or sovereign bonds. Then we have bonds which don't pay interest, specifically for Muslims, which we call them sukuk, aka Islamic bonds. So it depends on what type of investor you're advising. And then, of course, you can also invest in what we call mutual funds. So mutual funds are pool where money is pooled together. And then there's a fund manager who manages that pool, takes the money from the pool and invest in all these other things on your behalf. And then you expect some return this fund manager will give you.
Okay.
So it's less riskier because the management of that pool is done by a licensed fund manager who is a professional and who's doing 24/7. You can also invest in real estate. So I'm just giving the general areas where people can invest in.
Yeah.
Real estate is also now classified in 3 areas. One, you can go out, you can buy an apartment in Mbezi, Masaki, whatever. You can put on rental, and then you can be, earning your rental cash flows as your investment returns. Or there's a way now, real estate company is listed on the stock market, and then it sells small portion of that company, almost like shares, to individuals as investors. So it pools the money, just like the way a mutual fund will do. But specifically for this type of an investment, the fund manager will take all the money and invest all in real estate. So at the end of the year, he takes about 90% of the income which is earned from all these rentals, then distributes to all these investors. So this is the easiest way for individuals to invest in real estate, because traditionally, if you want to buy an apartment in Masaki, probably you want to spend $200,000 and above. But with this way, if the real estate company is listed in the stock market, then you can buy that in small amounts. We call that real estate investment trust, or REIT.
Okay.
And then, of course, now there's what we call fractional real estate, where you can buy just a small part of the whole real estate project through blockchain, as you're trying to tokenize that investment. And then, of course, you can also invest now what we call alternatives. So alternatives are investments which are not traditional. So that's where you have the things like commodities. We see people investing in commodities. There could be soft commodities. You buy, like what we do, we buy soft commodity. Let's say you buy cocoa, coffee. You can buy from farmers, and then you can sell. You can buy from the commodity exchanges internationally, and then you can sell when the prices go high. You can buy hard commodities like gold, oil, such stuff. And then, of course, so you have commodities, you have Bitcoin, crypto in general, and alternatives. Then there's new alternative asset class now we call private credit. And then, of course, and other types of alternatives which you can also invest in. So for young people, if you are in the age group that you said, that's the right age for people to expose themselves in high risk investments. If you're young, don't be boring when it comes to investing. That's your time. So put most of your investments in high risk investments, of course, responsibly. And then because as you age, the moment you get, let's say, to mid-40s, to 50s, to 60s, you won't have that luxury again to start investing in high-risk assets. So the general advice to young people is, if you are investing, again, this is another thing which is important, is you don't just invest in one thing and chill and wait to be rich. So you invest in a portfolio, what we call diversified portfolio. I think you studied finance, you know well. So the common advice in finance and investing is don't put your eggs in one basket. So if someone wants to invest, let's say 1 million for that matter, let's say someone is 25 to 35 or 20 to 35, and then they want to invest $1 million. So my advice is, let's say at least 70 to 80% of his money should be put into high-risk investments responsibly, and then the rest of that can be put in the low-risk investment just to preserve his capital and to diversify the risk. But as young people, make sure that you don't put most of your money, let's say, in bonds, for instance. So invest more in stocks. Look at things such as BIT, if you can invest in. And then look at things such as commodities, and then you can put some of your money in mutual funds and bonds.
Real estate is very capital intensive. And most people, whenever I tell them, hey, you can invest in real estate, they always complain that I don't have money because of the capital that you need to purchase the investment. As you gave an example of Masaki, if you want to buy an apartment today, it will cost you $200,000, for example. So you talk about REIT, where you can buy shares in real estate companies. So do you have REITs here in Tanzania where people can go and purchase their shares?
Yeah, so unfortunately, Tanzania, we have one REIT, but is not publicly listed. So Watumishi Housing is structured as a REIT, but is only available to private investors, mostly institutional investors who invested in that, pension funds, national housing, and the likes. But we are yet to have a listed REIT where everyone can invest in. So Tanzania currently no, but you have to explore the markets. You can, because the law now allows Tanzanians to invest as far as South Africa. So if you go to Johannesburg Stock Exchange, there are REITs which are listed and people can buy.
Okay, yeah. You mentioned a lot of investment vehicles that people can use. You mentioned real estate, stocks, bonds, commodities, etc. So can you list them based on their risk? Like what's the most riskiest to the list?
Yeah, so first of all, investing is about the balance of risk and return. So this is the most important thing that you know. You're balancing the two. You take less risky, you should know that you also get less return.
Yeah.
You take more risky, then you expect to get more return because you need to be compensated by the risk that you're taking. And then, of course, you come to a level based on your experience and the knowledge. Now you're trying to defy the odds by trying to take less risky and generate more return. And then, of course, for beginners, that's not what we're teaching. So for beginners, just want to balance between the risk and return. So we have the spectrum of risk and return.
Okay.
So you start with the less riskiest, which will also give you the less returns, which you call money markets. So markets could be treasury bills from the government, could be your fixed deposit account you open with a bank. It could be a call account, which is closely related to fixed deposit. So this is the first type of investment that is less riskier. And then next to it, I'll put mutual funds, which is pretty much a pool, as I said earlier, is reduced a lot of risk to investors, and the risk are also spread among all these investors. Then you have the bonds. You go further, and then the bonds. Now the mutual fund could be higher risky than the bond, depending on how this mutual fund is structured. I must declare that. So bonds could be less risky than mutual funds if mutual funds are structured in a way that they invest more in high risk stuff. Because the mutual funds, such as UTT, which is more diversified, they invest in bonds, they invest in stocks, they invest in shares, but the big portion of it invests in bonds, so it's less riskier. When you have mutual funds, which are what we call equities mutual funds, where they only invest in stocks. So you can have a crypto mutual fund where you take people's money and only invest in crypto. So that would definitely be, the risk will be higher than the risk of bonds. So I'll put bonds next to that. And again, it depends again with the bond. So within the bond, they are also declassified on their risk exposures. Government bonds tend to be less riskier than corporate bonds. Why? Because we don't expect the government to go bankrupt and default on its bond. But of course, it happens. Some governments have defaulted on their bonds. And unlike corporate bonds, where it's issued by the company can go bankrupt and then it can default on its bonds. And then next to that, so we have the money markets. Let's say you have bonds. Let's say you have mutual funds. And then let's put real estate next to that.
Yeah.
So the real estate the risk is higher than the bonds. The risk is higher than the money market. So we expect the return that you must get from real estate should be higher than the returns you should have generated if you were to invest in bonds, because you're taking more risk.
Okay.
And then next to it is the stocks. So stocks, shares are higher, the risks are higher than real estate.
Yeah.
The risks are higher than the bonds, and the risks are higher than the money market. So you expect the shares to give you more return than this other stuff. And then the end of the spectrum is what we call the alternatives now. So the alternatives, that's why they are called alternatives. First of all, they are not traditional.
Yeah.
And then the risk could be insane. They could be very volatile. And then we expect to get more return. That's why if you were to line up all these types of investments and you plot them on your return graph, you'd see these will stay at the end of your graph. So alternatives could, as I said earlier, could mean Bitcoin, crypto in general, and then could mean commodities in its generality. And of course, I know people are trading currencies and that kind of stuff. So that is an alternative. So that's how you would plot the risk and return balance across all these different types of investments.
So basically, there are less risky investments and high risk investments. So is there any investment that has no risk completely?
No, nothing. Except faith. Believe in God. That's the only investing that you can do, and there's no risk because you always get rewards for that.
So what's the risk in investing in bonds, which is the safest?
Okay, yeah. So bonds have two types of risks. Because when you buy a bond, you expect two things. Number one, there's a return that what we call the bond issuer, that whether it's an institution or the government that has sold that bond to you will pay you regularly.
Okay.
So if you're investing in traditional bonds, what we call a coupon, so the government will pay you interest.
Yeah.
For the government of Tanzania, they'll pay you after 6 months. If you invest in corporate bonds, let's say like a Samia bond, which was recently issued, let's say maybe they'll pay you quarterly, every 3 months, then they pay you your return. So that's what you call the fixed income, yeah. So you'll be paid out on regular basis. And then, of course, if you're not allowed to invest in bonds, you invest in a sukuk, which is Islamic bond, it also works almost the same way, where it depends on how that sukuk is structured, where you can be paid out maybe quarterly or biannually or yearly. And then another commitment that the bond issuer has to you as an investor is because when, let's say you put $1 million, and then the return on that bond is, let's say 10%, just for clarification.
Yeah.
So you're expecting every year to get 100,000 out of $1 million that you're investing in.
Okay.
So you're not taking your $1 million out. So you're only taking out 100K every year. Let's say the bond is for 5 years. So we'll be taking out every year your 100K, 100K, 100K. The 5th year, you'll get your final 100K plus your 1 mil, which is your principal that you gave this guy when you started investing. So those two things expose you to two risks.
Okay.
Risk number one is the inability of the issuer to pay you your regular payout on quarterly or on semi-annually basis. So let's say you invested and then your next payout is in, let's say, March.
Yeah.
And then March comes, the government or the corporate has no money to pay you. So that's one of the risks that you're exposed to. And number two is, okay, fine, they manage to pay you that. So you get your regular payout.
Yeah.
And then when the bond now matures, what we call bond maturity, at the end of that period of that bond, let's say 5 years, you need now to get your 1 million. Remember, what we call your principal, which we call a redemption now. At that time, it might come and then the bond issuer is not in a position to redeem that bond, to pay you your 1 million principal.
Where did it go?
No, they did not generate the money enough. Because, usually, if you take the money from people through bonds, you want to invest that money to do some sort of an investment, some sort of a project, which will generate some cash flows for you to pay your bond holders. Because that's the way it works. So the investment didn't go well. Or maybe there's misuse of the money. Maybe there's mismanagement. So those are the risks that you need to know before you buy a bond. How credible is the issuer of the bond? So the government bonds, which are treasury bonds, are regarded as less riskier among other bonds because for the government, when the time of the bond matures and it's supposed to pay you your principal, the government can issue another bond and pay you. So if you look at the structure of the bonds in Tanzania, they are bonds that have been issued for the government to collect the money to finance the infrastructure project, and there are bonds that have been issued by the government to collect the money to pay what we call maturing obligations, to pay those bonds which are maturing. That's why you reduce the risk of the government to default. In the US, what happens is US is rated as AAA. So if you're rated as AAA, that means your risk of default is pretty much almost zero. Okay. Why? Because government bonds in the US are issued in dollars, yeah?
Okay.
So if it matures and then the government does not have the money to pay you, what does the Federal Reserve usually do in the US? They print money. So they will print the money and pay you out.
Okay.
So that's why the risk is low. So that's the way, those are the two risks which are exposed to bond investors. And usually for you to mitigate those risks, if it's government, the risk is lower because the government will always issue another bond, then they'll pay me. So that's why people get comfortable. But we need to do in this country, which we are yet to do, and this is the service that we launched last year in partnership with another company, is to start rating these bonds. Okay. So the bond is rated. That's why if you go to US today or in more developed markets, they are rated bonds. They are junky bonds, which these can go haywire anytime, but the return must be higher. So the unrated bonds, the inflation-rated bonds. So there are all these types of bonds which are structured because there are companies that can analyze those bonds and advise people, don't invest in this bond unless they give you X return.
Out of all those investments that you have said, what investment has proven historically to be the highest return of them all?
So unfortunately in Tanzania we don't have, but the two types of investments that have proven to be the most performing. Number one, of course, is gold. Over time, because gold has always been treated as a backup reserve when things go bad. So people always run to gold. So gold has always been one of the best performers. Number two is indexes. So we don't have indexes in Tanzania. So an index is a pool of different types of stocks bundled together, and then they're trading as if they're trading as one stock, and then you invest in that index. So the best performing index so far, as we all know, is S&P 500 index in the US, which is listed. So S&P 500 is the 500 companies in the US.
Okay.
Which of course have been bundled together, and of course they're now listed in trading as an index. So S&P 500 has proven to be the best among other types of investments. So those two things, gold and indexes such as S&P 500.
Okay, so S&P 500 is basically, instead of you investing in individual stocks, you invest in the market as a whole. Okay, and as you said, you don't have anything like that here in Tanzania?
Not listed, yeah. Which is trading, but you can do that in South Africa.
Okay.
Yeah.
I have a very hard time in understanding Tanzanian stocks because I once went to the stock exchange to one of the agents, and I saw that stocks that have been traded for some companies, the price does not go up or down.
Yeah.
It's like fixed. I'm not used to that because when you invest, let's say in US stocks, they always fluctuate. Let's say I buy Tesla today. I'm expecting I can benefit from the appreciation of the stock.
True.
Then why do Tanzanian stocks remain constant?
Yeah, so I think it's the way the Samsung Stock Exchange has set up its regulations on what there's a volume that needs to be reached for the stock to move its price. Okay. So this is the way that they've set it up. That makes it not easy for the stocks to move the way you see in other markets. So as a result, if some of these stocks don't get to those volumes or to those criteria which the DSE has set, you never see them moving. That's why if you look at the stock market report for last year, there are stocks which never moved an inch the entire 12 months, which is insane. Because if you're investing in stocks, we expect you to get more returns rather than someone who invested in bonds because you're taking more risk. But again, of course, you can also get more losses in stocks than in bonds because you're taking more risk. As I said, it's about risk and return trade-off. So that's the challenge that we have. And number two, we don't have enough volume of trading in Tanzania because there are less people who are investing, there are less people who are trading. We hardly have 1 million Tanzanians who are investing in the stock market. We have less than 1% of Tanzanians who have invested in bonds. So the numbers are very, very small. Other thing which we also see is we don't have the market makers. You don't have. So people such as myself, you need to have, this big community of fund managers, asset managers, investment bankers who will be operating in these markets and take people's money and take positions and trade and stipulate the market, which is not the case here. You want to invest, you go straight to the market. But in more developed markets, you come to me. And then I'll manage your money and then invest in your behalf. So those are things which you do as a market to help that. Otherwise, you don't see these stocks are moving. If you go to US today, like New York Stock Exchange, stock one stock can exchange hands 20 times a second. So it's insane how much stocks move between hands and how they influence the prices.
In Tanzania, most stocks, they don't appreciate in price, or they take a long time to appreciate in price. So what benefits do people get in buying those kind of stocks? Let's say a CRDB stock.
If you're buying a stock, usually there are two primary benefits that you get from investing in a stock. So this is textbook wisdom. When you buy a stock, two things will happen, if they will. Number one, if you bought the right stock anyway, is capital gain or capital appreciation.
Okay.
So you bought a stock at 150, which CRDB was, and then CRDB today is 600 plus. So that's how you make your money from stock investing. So it is increasing its price, and you want to sell it, and then you can cash out your capital gain.
Okay.
So that's one thing. Secondly is when you invest in a company, by buying shares, you become a shareholder. As a shareholder, at the end of each year, if the company has made money, and of course the AGM was approved, then the company will also pay dividends to the shareholders. So that's the second way for you to make money. You get dividends. You get a portion of the profit from the bank as a payout to each share that you own from that company. So those are two primary benefits you get from investing in any stock. And of course, now there are other additional benefits that people get from holding shares. You can use some of your shares as collateral, and you can go to some of the financial institutions and lend and borrow money against the shares that you're holding. So there are some other additional benefits that you can get, but those are the two primary benefits that you get by investing in any stock.
Most people lose their money whenever they try to invest, let's say in stocks or real estate, because they don't have the right knowledge. I always tell people that real estate is not a scam, but without proper knowledge, you'll get scammed and you lose your money. So what are the top 3 mistakes that you would say that people make here in Tanzania when they try to invest, and how should they avoid them?
So one of the things we call head following, HERD, head following, as in you hear Mussa is investing in real estate, you also want to invest in real estate. So you don't do your research. You don't know his risk appetite, because risk appetites are different. So you invest in things because people are investing in that. You hear people investing in Bitcoin, you also want to invest in Bitcoin. So that's the first mistake that I see people making. Number one. Number two, get rich quick schemes. People want to get rich quickly. So because we have clients, you come to me and say, okay, Mussa, you know what, give me your money, we'll manage your money, we'll generate 15% return on investment yearly. And you're like, 15%, 12 months? That's very low. And you need some investment that will give you 30%, 40% return on investment. And guess what? There are no enough legit investment in those ranges of returns. So you end up in the wrong hands because you're now attracted to these schemes which promise you 1% return on a daily basis, which gives you 30% return monthly. So that's the second mistake that people make. By trying to get rich quickly and then investing loan things. So they go into pyramid schemes and those Ponzi schemes. And then, of course, number 3 is investing in things they don't understand, even if they're legit. And this, of course, is the wisdom by Warren Buffett himself, that he usually says, don't invest in things you don't understand. So make sure that before you invest in anything, know at least the basics. You don't have to become an investment expert, but at least to know that. So let's say you are investing in real estate. Real estate is split by itself. There's commercial, there's residential, there's industrial, there's social utility. What sort of returns can I generate based on the category for investment? Give you a simple example. 2022, the report on investing in real estate in Tanzania said in residential apartments, Tanzania generated 6% annually.
Okay.
And investment in office and industrial buildings created about 10% return on investment. So before you invest in real estate, these are things you need to know. These are the basics, very basics that you need to know. You also need to know the volatility of the industry which you're investing. What pushes the prices of the stocks up? What pushes the prices of real estate up? What sort of things, if they happen, real estate will be bad hit? What are the things, if they happen, real estate will make more money? So these are the things that you need to understand. Someone tells you, okay, we generate 20%. You need to know how are they generating those 20%. Because people go into this type of scams and all that, and then someone tells you they'll give you 10% return monthly. And you're like, okay, thank you, sir. Are you telling me 200 plus a return a year? Where are you investing my money? Because I need to know. Where you can get 30% return on a monthly basis or 2% on daily basis. So those are the main mistakes from just general perspective. I don't want to go into the technicalities of that, where I see most people make mistakes.
Personally, when someone comes to me and offers me an investment opportunity that will give me, let's say, more than 30%, immediately a bell rings in my head. I have to be more careful right now. I have to do more research. So what kinds of percentages that when someone brings to you and you'll be like, this is 90% scam?
So one thing is you need to know what are the average returns in the market which you're operating.
Okay.
So in Tanzania, you can ask yourself what sort of returns are generated by all the investments. So you go into bonds. We all know the rates that are paid from bonds. And they're published actually on BOT's website. So we know that there could be 11%, could be 9%, could be 14%, could be 15%. So you go to, let's say, the likes of UTT, they'll show you the returns which they're generating. They'll tell you 12%, 13%, 14%, correct? So we all know what the market in Tanzania generates. Unless this guy that's taking your money is investing in another market, then it's important for you to know in that market what are the average returns. So we know in Tanzania returns tend to fluctuate between 10 to 20% right there on average. Of course, stocks, because the returns are not fixed, can go much higher than that, can go much less than that because it's more volatile. But on average, we expect the returns to range between, let's say, 10%, let's say 7% actually. Because someone you want to invest in money markets, let's say 7% to 15%, this is the most ideal range which we see in the market, and some can outperform that, let's say to 17, 18 to 20%. That's annually. Annually. So if someone is telling me they can do that monthly, then okay, I pay attention to that. Because we say you get scammed when greed exceeds common sense. That's what happens. So it's very important for you to always go back to your common sense before it exceeds greed. Greed exceeds common sense, and then you get scammed like that. So those are the returns which you see in the market.
I saw one of your posts. You posted on your Instagram. Before it gets scammed, I always pass through their Instagram and see what kind of value they're sharing. So in one of your posts, you listed the best performing investments of last year. And the number one was, I think, 124% return, which was Bitcoin. People are very skeptical about Bitcoin. And when I personally hear something offers me 100% return, I always take a lot of steps back, such as Bitcoin. So why do you think Bitcoin had so much return over the past year?
Because it's the most riskiest. It's as simple as that. And it's about long term. Because let's say if you invested, because that's the returns you get if you have invested for 12 months without taking your money out. So it's because that now as we're speaking, there's only one way for you to make money from Bitcoin is the increase in the price. That's it.
Okay.
So I think yesterday Bitcoin was about 103K US dollars.
Okay.
And if you read the reports now and the projections, I don't know if you're following up. Yesterday, Trump was speaking with the World Economic Forum online, and he said he wants to put U.S. as the center of AI and crypto. So all those who are in that industry know for sure that if that's the direction of US, which is the largest economy in the world, at least in the next 4 years, the impact on Bitcoin prices will be positive.
Yeah.
So people start buying now. In the next 4 years, you will see me posting, and I tell you, you know what, I made 300% because I invested 3-4 years ago and expected the prices to go higher. But at the same time, it can be on the list of my worst investments because I've lost all the money because it's very volatile. So that's one thing for sure that happened. So I made that because I invested early in the year. I held my bit, and then at the end of the year, I didn't even sell them out actually. Then see the prices. That's how you measure those returns. And most importantly, now you're speaking about Bitcoin. It's important for people to know that the percentage, you remember we talk about these different types of investments. The percentage of investments per category in your portfolio are heavily based on your age.
Okay.
As I said earlier. So someone such as yourself, I expect you to have less bonds, most likely, less money market, more real estate, more stocks, probably more alternatives. I don't know your age by looking at you. And someone who is retired, 60 and above, I don't expect him to find in his portfolio there's a Bitcoin in investment. So I don't expect Bitcoin in the retiree's investment account because he's not supposed to do that. That is not his stuff. Unless this retiree has multiple sources of income and is not only using his retirement savings to invest, if you get my point. So that's one important thing that people need to understand. So Bitcoin, as controversial as it can be, of course, crypto is controversial. If you ask me, Bitcoin is not, because Bitcoin is just one of the 10,000 plus cryptos which are out there. And for me, Bitcoin is more mature, is more than 50% of the entire crypto market globally. And then in some markets, we know some markets, if you go to South America, one of the countries we know declared Bitcoin at legal tender, where you can use Bitcoin and you use it to keep your national reserve. We see some countries now buying Bitcoin for their national reserve. So we're seeing that. Companies such as BlackRock, which is the largest fund manager in the world, managing more than $10 trillion in assets. They launched a Bitcoin ETF. So all those things will tell you that Bitcoin is pretty much going into more maturity as an investment. But again, you need to do it cautiously because it's not for everyone.
Warren Buffett is considered as one of the greatest investors in our generation.
True.
In the last 100 years. And he has a partner called Charlie Munger, who is dead, by the way, rest in peace. Charlie Munger once said that Bitcoin is a rat poison. What do you think about that?
No, with all due respect, because Charlie and Buffett, of course, we cannot say anything against them. They're among the smart investors that we have seen in history. But investors have their perceptions. If you listen to Warren Buffett himself, sometimes he tells you the investment that he missed, that he thought were just hypes. So that's what happens. So it's not always the master gets it right. There are moments when they can miss some potential investments down the road. And then 20 years down the road, they are like, wow, I wish I did that. I wish I did that. So with all due respect, I think he holds his position, which we respect. But, we have our own perceptions when it comes to that. And we strongly believe that if we do it right, BIT should be in a position to become a mature asset and people should hold it. And it's not necessarily the poison the way he put it, but I respect what you said. That's why I said earlier if you're investing in Bitcoin and then it has to match your risk appetite, it's something that you can do. I cannot put 20% of my money in Bitcoin, by the way. So I always limit it to 5 to 10% of my portfolio. If I was much younger, I probably have done more. But that's the way I look at Bitcoin, and I respect all the people. Not him. There are a lot of issues that people talk about Bitcoin. As a Muslim as well, there are some scholars who say it's not halal, some say it's halal. So there are a lot of controversies around that.
I remember Donald Trump himself, he once said that Bitcoin is a scam. But right now he has embraced crypto. And a few days ago he launched the Trump coin. Yeah, what do you think about the Trump coin?
No, man. For me, I don't do any coin rather than Bit. That's it. Yeah.
I personally think it's just a meme coin. And it's a hype.
For sure.
It's gonna die.
Yeah.
I don't know. That's my bet.
Yeah, for sure.
In 3 years, there will be no.
For sure.
Trump coin.
For sure.
Inflation, as people say, is the most brutal taxation alive right now.
True.
Yeah, because it eats away your wealth without you even knowing about it. Yeah, it's a silent wealth killer. So what strategies should investors employ to beat inflation?
So first of all, any returns that you get below inflation, then it's a bad investment. It's as simple as that.
Okay.
So that's the first thing that you do. When you want to invest, the first thing that you need to return on your money is inflation.
Okay.
That's what we call inflation adjusted return. So that's the first thing that you need to do.
Yeah.
And then secondly, is what we call a premium.
Yeah.
So for me, if I were to invest my money, I look at two things. Number one, the returns which I'm getting from these investments are higher than the returns I would have generated if I were to invest my money in low risk investments such as bonds. That's the first thing that I look at.
Okay.
And then the secondly is that return plus inflation as my premium, and that's the minimum return that I need from any investment. So as an investor, if someone wants to invest your money, if you want to invest in anything that you see out there, the first thing that you need to make sure that the returns must be higher than inflation. Then that's when the conversations begin. Below that, no conversation.
Okay.
Yeah. And you can do that. The best way to mitigate that risk is to diversify your portfolio. Because if you only invest in one thing, the entire portfolio, and then inflation hits, because when you're starting out, probably the returns which you are forecasting are higher than the current inflation. But things can go south, as what happened with the Russia-Ukraine war. Nobody projected the war, and then it hit bad the agricultural industry, especially around wheat and then fertilizer, and then the prices spiked. Yeah, and then if you only invested in one thing, and then you're exposed now, most likely inflation will eat you for lunch. But if you diversified your portfolio and you didn't only invest in one thing, so whatever that is hit by inflation, and then probably inflation won't eat the same with other types of investment you have in a portfolio, then they can diversify your return, and then of course they can reduce your risk exposure of your total return as a portfolio.
What's the current rate of inflation in Tanzania for the people who don't know?
Now is around 3.1%. Yeah.
So any investment that offers you less than that,
no,
it's not an investment.
Kaput, yeah.
Okay. And how about the bonds? Let's say if a bond offers you 15%, do you have to subtract inflation out of that?
Yes, correct. So that's one of the risks. Yeah, no, it's not.
Okay.
Yeah.
And personally, through your years of experience, what the most challenging investment decision that you had to make, and how was the outcome of that?
So the challenging for me was more on, I think, leaving investments which pay interest and solely focusing 100% on halal investing.
Okay.
That's been the main issue for me in terms of transition, but it's been the most rewarding and the most beneficial for me. But that's the major decision that I've made in terms of leaving all these interesting, kind of stuff that you see in market. Because I don't like being a boring investor. I want to invest in things which, I can every morning I look at the graphs and the charts and I see the movement. So things such as derivatives, for instance, which are very interesting, but most of the derivatives are not halal. So I had to liquidate and exit that position, for that matter. So that's the main decision, if I may say, when it comes to investing that I've made. Yeah.
I'm always fascinated. What is halal investing, and how do people benefit from an investment vehicle that offers zero interest rate?
No, so halal is not offering zero. Okay. That's the one thing. There's a huge misconception.
Okay.
No. Halal investing gives you money, but gives you money not in the same way interest will give you money.
Okay.
So very simple example. If you invest in a bond, in a government bond, the government bond, let's say, will give you interest of 10%.
Okay.
So this is not allowed. So this is not halal because it's the pure interest transaction. Okay. Correct. Okay. But an Islamic bond, which you call sukuk, what happens is, if I give you my money, you issue a bond, I give you my money, you're going to use this money to invest, and I become a part owner of that investment.
Okay.
So with the traditional bond, is the relationship is the debt holder and the debt provider. Okay. That, you know what, I gave you 10 million, these are my money you owe me, plus 10% interest. You have to give me my money. Say you must. Okay. It's a debt obligation.
Yeah.
Bond is a debt obligation. Just like the way you go to a bank and take a loan.
Yeah. And
then second, of course, they cannot guarantee you in the real sense, but it's pretty much more guarantee. As I said earlier, with government, they can always print money, they can always issue another bond, and they can pay you out. But with a halal bond, what happens is you issue a bond because you want to expand your podcast business. Okay. The moment you do that and take my money, is not a debt obligation. Now I become a part owner of that podcast. Okay. So whatever returns that you generate from that business at the end of the year, I'm entitled to a certain portion of the returns which you are generating that we agreed in prior when I was giving you the money. So halal investing is about two things. It's about risk sharing and profit sharing, which you don't get in traditional bonds.
What if you get a loss?
And then, as I said, it's risk sharing and profit sharing. So if you get a loss, then we split the losses. If you make money, we both share the profits. That's why before I invest in the halal bond, I must make sure that I invest in a company which is legit, which is well structured, which is proper, that the chances of them losing my money are pretty much slim.
So halal investing, what's the difference between halal bonds and stocks?
So stocks, within stocks themselves, there are stocks which halal and there are stocks which are not. So when it comes to stocks, pretty much because you represent some sort of ownership.
Yeah.
With bonds, with the halal bonds, because there are also different types of halal bonds, and I don't want to get into technicalities of that. Some will give you, of course, they give you the ownership of what we call the underlying asset, where you invest the money, whether it's a project or something. Let's say I give you the money, and then use the money to buy a building. Then I become part owner of that building, and I lease that building out. So all the lease payouts that come out, I'm also entitled to those lease payments. So with stocks, it's the same thing. When it comes to halal investing, you're not allowed to invest in certain types of stocks. So you don't invest in stocks of a business which is regarded not halal. For instance, you cannot buy stocks of a company which is producing alcohol. You cannot buy stocks from a company which is producing tobacco. You cannot buy stocks from a company which is trading in interest.
Okay.
So that takes you out from so many stocks in the market. That's level one. Level two, even if the company is doing a business which is regarded as halal, if that company is financed by interest debt, and that debt has more than 30% of the total assets or the total market cap of that company, then again, I'm not allowed to invest in that company. So that's how you would classify stocks from the halal perspective.
And can you give examples of halal bonds that people who are interested, because I'm pretty sure there are a lot of Muslims who are watching and they hate interest. Can you give some few examples?
Yeah, so currently in Tanzania, we have almost close to 14 halal bonds which have been issued. Unfortunately, only one which is listed. Because when you are issuing a bond, you have two options. You can list it on the stock market, or you can issue to what we call through private placement, where it's not listed. It's just sold through private individuals and institutions. So people reach out to you, to Mussa, hey, we have a bond, and then the minimum investment is 20 million. Are you interested? And then you buy it. So majority of those are like that. And there's only one which was issued by KCB. It's called Fursa Sukuk. It is listed on the Islam Stock Exchange where people can buy.
Over the years, what's the best investment that you have ever made, and what percent did you get out of it?
I think it varies from year to year. As I said last year, if you look at NVIDIA, returns were outsized, most of the investments. So I'll put stocks up higher, somewhere there, for me, and commodities. Those are the two types of investments which have always generated a lot of returns.
You have a hedge fund yourself, right?
Not a hedge fund.
What's the name of it?
I don't know which one you're referring to. Because in Tanzania, you cannot register a hedge fund.
Okay.
Yeah. Because a hedge fund is a different animal.
Okay.
Yeah. So SSC Capital is an investment bank.
Okay.
An investment bank is not a hedge fund. It's technically a company that, one, advises, two, helps to manage people's money. So we do what we call wealth and asset management. So that's the things that we do. So hedge fund is different because Tanzania, we don't have even the laws and regulations to regulate hedge funds. Yeah.
So what's the difference between your two companies, Shirkah Asset Management and SSC Capital?
So SSC Capital is broader than Shirkah. So Shirkah is more of a subsidiary of SSC Capital. So SSC Capital, what we do 5 things. Number one, we advise companies, what we call strategy advisory. So we advise companies on their strategy, long-term strategy, how they want to build their companies. Maybe the company is making losses, how to restructure the company to be profitable. Maybe they took a bad loan and then the bank wants to sell their assets, then we can restructure that debt as well. They want to build a new factory, then we do the feasibility study, we do the research. The international company wants to set foot in Tanzania, like the one we are working on now. Then we help the company to come to Tanzania and set up here. So that's number one.
Okay.
And number two, we do, as I said, asset and wealth management, where we help invest people's money. So we advise you, we build your portfolio, and then we do placement of your money into different types of investment within and outside Tanzania. And number three, we do what we call mergers and acquisitions. We help companies sell their companies to others, buy companies, or merge those companies. And number four, we raise money for companies. We call capital raising. And we raise money for companies by the use of what we call alternative finance, such as private equity, venture capital, angel investing, and other kinds of stuff. That's, I think you mentioned about venture capital.
Yeah.
And then lastly, now, as I said, we have partnered with another international company to start offering credit rating in Tanzania, where we'll be rating bonds, rating governments across Africa before they issue international. So that's what SSC is doing, operational 15 years.
Okay.
Shirkah is a new company. Pretty much this is the second year. So it's a subsidiary. So we decided to take some of the activities from SSC and put them under Shirkah. So Shirkah now, as we're speaking, is 100% asset management company. It only does investments. That's it. We don't do anything else apart from investing, unlike SSC, which is more broader. So we only invest. And now we have two models or schemes. The first scheme is we have an app, a mobile app, where you can download it as Shirkah Invest, and then you can start investing. You can invest in Tanzania in stocks. You can invest in Tanzanian Halal Fund, which is there's one. You can invest in real estate. You can also invest in Kenya. We have a fund for Kenya called Mussa X, which is listed on the app as well. And this Q1 of 2025 will also have one of the REITs from Johannesburg Stock Exchange to be listed on the app. So that's one option we have. Second thing we do under Shirkah, we call Shirkah Premium, which is a customized and personalized portfolio management service, where we take people's money, minimum of 10 million, and then we invest pure in halal stuff for you. And then we give you quarter reports, and then we generate a minimum of 15% return every year.
You have been doing that for 15 years.
SSC Capital, 15 years, and Shirkah is new. This is your second year.
On average, how much have you been making for your investors that give you money to invest?
No, good question. So what we are doing now is we are opposite of what UTT is doing. For instance, and I'm not sure if you're supposed to mention these companies. So them as a mutual fund, they collect the money They invest the pool and they generate one return for that pool. So if you ask that question to people such as them, it's easy to tell you 14% to operating 30%. Yeah. For us, we don't do that. So what we're doing is that's why we call it a personalized service. So we don't do a pool. Yeah. So we have individual portfolios for people. So each portfolio, the returns have been different. So the minimum that we generate is 15%, but we have some who have generated 20%, some 25%, but the highest that we did last year was 36%. For one of the portfolios, yeah. So it's personalized, because if you come to us and you tell us, okay, Salum, I want 80% of my money to be invested in high risk assets, definitely you won't get 15%. Then your returns will be high. Okay. But if let's say your father comes to us, or your mother comes to us, and then you want to invest his or her money, definitely you won't invest their money the way we invest your money. So the returns won't be as high as yours.
As a venture capitalist, do you invest in startups?
Yeah, so we stopped, but we resume probably before the end of this year, inshallah.
Before you invest in a startup, what metrics do you look at it to rate it that this has a huge potential than the others?
So good question. So one thing that people need to know is the way a venture capitalist makes money is I invest in your company today. I expect this company will blow in its value, and then I'll sell my shares and exit that company at some point in the future with X amount of my return. So the average return now is about 3x, most of the VCs that are investing. So I want to triple my money if I'm investing in you. So for me to do that, there are things which I must see in your business before we invest in, or most of the venture capitalists would invest in. So the first thing is, why are you doing this business? Are you solving a problem? Are you addressing an unmet demand? So why are you doing this? So most investors will want to see, what problem are you solving? Because why is it important? It sounds like cliche, but why is it important is because if your business is solving a problem in a society or in a community, it says immediately there are people outside this door are waiting for that solution. The moment you go there, boom, solution, this is my solution, people start paying you. One of the major challenges in Tanzania that we have, that we hopefully will be able to address, is most of the hospitals here cannot detect cancer in its earliest stage. If you have a solution that can test and can detect cancer in its earliest stages, which can be easily to address it, guess what? People outside this door will be flocking to your hospital, correct? So if you're solving a problem, that's the one thing that we are looking at, Number two is, fine, you're solving a problem, and then you have this business, but how scalable is the business that you're starting? Because there are businesses which you can hardly scale. If, let's say, you're running a consulting firm, this is one of the most difficult businesses to scale. So rarely VCs will invest in a professional services company. Let's say it's a law firm, or is a financial consulting firm, or is a HR firm, and that kind of stuff, because it's not easy to scale these businesses. So that's the second thing that we're looking at. Scaling as in, let's say, for instance, you're looking at someone like Benjamin Fernandez, and shout out to him, and I hope you don't mind mentioning some of the Tanzanians who have built businesses which are heavily scalable. So you see, you build this solution, international money transfer. Tanzania alone sends home, Tanzania's diaspora sends home between $700 million to $1 billion a year. I know it fluctuates around there. So this is the business that you can do, but not just in Tanzania, but across Africa. So how scalable is the business? That's number two. Number three is the team that you have. Because it doesn't matter how smart you are. It doesn't matter how hard work you are. If everything is done by yourself, you have the limitations in terms of growing that business. You can only do so much. So who is behind you, that is working with you, that will help you get to those levels of scale? So we're looking at complementarities of the people that you have. How knowledgeable are they? How much do they know about the product? How much do they know about the market? And all that kind of stuff. That's why I always mention this, even when I do my public talks, when I talk to startups, is if you have built a medical or healthcare startup and you have a team of 5 people, and they're all medical doctors, you don't have a team. If you have a company that is tech-based, and you have 5 team members, and they're all software developers, for me, you still don't have a team. So you must have a team that has complementary skills. That's number 3. Number 4 is the size of the market, which is tied to scalability. Because, okay, fine, you may decide to come to Tanzania and set here an agency for selling Lamborghini. But how many Tanzanians will buy a Lamborghini a year? So it was the size of the market that you want to do.
Yeah.
So Tanzania has a small market, let's say, of certain types of the products that you bring to the market. So that's very important for you to understand. You may bring a very interesting product or service in Tanzania, but the market for that service or product is so limited that limits your scalability as a company, and you can only grow X. That's it, and that will be your limitations. So as an investor, you want to invest in that company. So you need a mix of those 4 things: the problem you're solving, the team that you have, the size of the market, and then, of course, the scalability of the business. 4 things. Those are 4 things that you're looking at. The rest of the things, they're negotiable. You can sit down and talk.
I'm glad you mentioned Benjamin Fernandez. Shout out to Benjamin Fernandez. He's one of the people who is doing great in the fintech space.
Yeah.
And Benjamin, if you're watching this, would like to have you here on MYOD Podcast so that we can learn about you, your personal growth, and how you managed to grow your company until where it is right now. And you talked about scalability. I remember even Mo Dewji, who is one of the wealthiest people in Tanzania, was asked in one of the podcasts that how do you manage to have a lot of companies? He mentioned that most startups in Tanzania, they're not scalable. That's why you should have multiple of them. So I highly empathize on that. And as you said previously, you should not put all your eggs in one basket. So you always need to have different sources of income. So
for sure,
one might fail and another one might save you. Yeah. So when it comes to investing, there is always winning and losing. So can you share an example of investment that you did and it didn't go as planned? And what did you learn from that?
Yeah, we invested in JATU. Some of you may know.
Yeah.
So I don't know. So JATU PLC is a Tanzanian company. Young people decided to form this company. It was listed in the Islam Stock Exchange. Why? Why was it listed?
Yeah.
Why did they start the company? Yeah. The initial thinking was great, if you ask me. Yeah. Why? Because a lot of Tanzanians have tried to start farming businesses, but all these businesses have failed because these people are based in cities. You are in Bezina right now, and you want to have a farm in Mbinga, Songea. It won't work, trust me. So we needed someone to come with a solution that will play somewhere in the middle as intermediary, who will take your money and go to the farms, buy those farms or lease those farms, put in stuff, manage the farms, sell, make the money, pay you back at the end of the season.
Okay.
So for me, it makes sense as a business model.
Yeah.
And they tried to do that. So before the company was listed, the company grew by more than 220%.
Wow.
So it made a lot of sense for us to invest in the company. So I did, and we invested some of our clients' money.
Okay.
Unfortunately, there are some underlying factors which for us, we feel like, as a listed company, you have a board, so we're sure of the governance. Things will change, and then in the company will be a decent investment.
Yeah.
And then things didn't go as planned. So when the company took the money from the investors and they went all the way to the farms, then the business model was, don't sell the crops.
Okay.
You need to set up factories so we can process what we produce, because we'll make more money if we sell as value-added stuff. But how can we sell our stuff once we manufacture them, once we process them? We need to have our own outlets. So they also open their own outlets to sell their stuff. Okay. So you can imagine the cash conversion cycle gets more prolonged, and the business model, had to break down. So you take someone's money, you take to the farms, and then you collect the crops, you take to the processing facility, you take to your own retail outlets to sell to people to get the cash so you can pay back your investor. That cash conversion cycle is longer than the investment cycle. So what happens is when the investment matures, and then you have a liquidity problem because you don't have the cash to pay your investors. Remember the way the bond would work.
Yeah.
So that's the problem that they faced. Unfortunately, the management at the time, maybe in the board, didn't take immediate measures to address that.
Yeah.
So it went that way year one, it went that way year two, and then everything shambled, and then the company pretty much almost collapsed. The good thing is it was not delisted from the stock market, and then the management, one of the CEOs who's in jail as we speak, and then people left. The company ran out of money. The board didn't want to proceed with the company, so we lost money. But the good thing is we are also actively involved because we also advise some of our clients, so we have huge responsibility. And because we have expertise to restructure companies, we are now have been engaged by JATU board to assist the company to restructure it and to come back strong, and then to start to resume its activities and be able now for the investors to recover their investments. So we bought a stock at 500, and the stock now trades between 260 to 265 around there. So almost 50% of the money was lost. So that was something to learn that. You can invest in startups because it was a startup then, but you always need to have extra due diligence before you make such investments, which you do, but it happens in investments. So that's one of the things that happened, if you ask me. I think the other thing. I think we have missed some investments. Even with Bitcoin, I didn't invest very early. I was also skeptical, so I came on board late. I think I would have made more money if I went in early and strong, and in the money that I put in then. So that's another lesson that I've learned, that you don't just dismiss things. You always need to put your analysis properly to make sure that this is a good investment and how much you can put investment into those. And I think I started investing very late, and I don't complain because for me, I believe everything has its own time. Yeah.
When JATU almost collapsed, what consequences did JATU face from that?
So as I said, one of the CEOs was implicated and sent to jail. Okay. So I think he's serving now. Number one. Number two, the board had to resign. Okay. Number three, the company, of course, went through a lot of investigations. PCCB, police, some of the assets were confiscated just to make sure that if they were to dispose, they could be disposed, liquidated, and compensate any obligation which the company has. So all the legal measures were taken. Yeah.
JATU was an agricultural company, as
Correct.
you said, and there's a very famous saying in Swahili that kama mnataka mali mtaipata shambani, and a lot of Tanzanians, I can say the majority, depends on agriculture for survival. But when you take a look in the entire world, the countries that depends on agriculture are among the poorest countries in the world, because most developed countries depend on industries, on tech and stuff like that. So what's your perspective on investing in agriculture in Tanzania? Is it as promising as people say, and what are the challenges?
So first of all, as a country, as an economy, we need to treat agriculture as a transition to industrialization. Okay. So we don't need to look at it as its own start and the end.
Okay.
So that's one thing we need to do. That's what happened in most economies. You have the agrarian revolution, and then you go to industrial revolution, and now of course you're talking about the fourth industrial revolution. Correct. Okay. So that's one thing you need to do. You need to transform agricultural economies into industrial economies and use the agricultural products into as raw materials for your industrialization.
Okay.
And as you do that, one thing you must do as an economy, first of all, looking at the macro level, for you to use agri
Yeah.
As a catalyst for industrialization, you must invest heavily. 65% of Tanzanians today are involved in agri, but 80% of those have farms between half an acre to 3 acres, and with poor or low mechanization at all, low productivity. There's no way agri can transform people's lives, and there's no way with that structure agri can industrialize the country. So you must invest in agri. As you invest, what happens? You mechanize.
Yeah.
As you mechanize, guess what happens? You create jobless people in rural areas, because you know what? Now a farm that will be plowed by 20 people can be done by only one person with a tractor.
Okay.
So what happens to 19 people? So the 19 people are now transitioning from farm labor to industrial labor. Okay. That's how you industrialize. That's how you use your own people now as a source of labor. So that's one thing that must happen for us to see, but we cannot remain. That's why if you go to the US today, US is one of the largest exporters of food products.
Yeah.
But the Americans who are involved in the agricultural sector are less than 10% of the population.
Yeah.
Tanzania, you can imagine, we invest largely maybe $1 billion and slightly more $1 billion of food products, agricultural products rather. But 65% are involved in agri. So you'd see the mechanism of that. Number one. Number two, if you want to invest in agri as an individual,
yeah,
and for you to make money, there are certain preconditions you must fulfill. Number one, farm size. You can never be rich in agri if your farm is 1 acre, 2 acres, 3 acres, which is the majority. Forget it.
Okay.
That's number one. Number two, so farm size. That's when people who make money from farms, they have, let's say, 100 hectares, 1,000 hectares and above. But that's when you can see the economies of scale. That's when you can start making money. Number two, you must mechanize.
Yeah.
You cannot make money from agri by the use of very traditional instruments. So you must mechanize. And mechanization today in agri is beyond just using tractors to plow the land. Okay. You know, it's from planting, from plowing to harvesting. So you need to do all that. Number three. Number four, you know, all the services that the farmer needs for them to do this business commercially must be available. Okay. Crop insurance, for instance, you know, access to finance,
yeah,
you know, for farmers. Today in Tanzania, banks, all banks that you see in Tanzania, we have 30 plus banks.
Yeah.
They give more than 20 trillion of loans at any point in time. And only 10% of those loans go to agricultural sector. So there's a huge gap of funding for this sector. Yeah. And then with that, you can hardly transform that. And then, of course, as a farmer, you should not, and you cannot, anticipate to make money from agri if it's a rain-fed agriculture. Okay. So you must have irrigation schemes for you to diversify and mitigate the risk of climate. And now, of course, we all know about climate change. Rains don't come as usual. They might come late. They may come more than you expect. So all these things for you to mitigate, your farm must be mechanized and you must be scientifically done. Farm management, we are not doing that as a practice. You buy a farm in Morogoro, and then you take someone from the village. Bane, I'm looking for someone here to manage my farm. Call him Zesabuli. And then that's how you that becomes your farm manager. And then he calls you, sends you photos on WhatsApp. Forget it. You must have people who are professional farm managers. And this is one thing I always tell people, that we have SUA, for instance. SUA has produced a lot of brilliant young Tanzanians. Yeah. So how can we just build additional skills, let's say management and finances, and turn these guys into professional farm managers, yeah, who will be given all this, the things that they need: a good house, a car, you know, all the facilities they need, whatever that you want to put them, good pay, and then these are the guys who can manage these farms on your behalf. And then, of course, the other things which you all know: access to markets. You don't just produce and wait for the markets to come to buy from you. You must know where you're going to sell your stuff. And then, of course, 25% to 40% of all farm produce in Tanzania goes into waste after harvest. We call post-harvest losses. So one thing that you should do is, what are we doing to reduce those losses once the harvest go off the farms? You know, some are very perishables. How much have you invested in terms of cold storage facilities in those areas where these perishables will be stored. So there are so many things that need to be done for you to look at farming as an enterprise. But I tell you, if you get it right, I'm sure we can uplift so many people out of poverty and build their wealth from that angle.
There's a saying that says that time in the market is better than timing the market. And as we know, for example, most investments, we usually benefit from price appreciation. For example, Bitcoin.
True.
You can never make profits unless you sell. And as well, you can never realize any loss unless you sell.
Yeah.
So I was wondering, how do you determine your exit strategies for an investment? Like what factors influence that timing?
So when it comes to investing, for me, first of all, I'm a value investor, by the way. So I only invest in things from the intrinsic value perspective, which I know they are underpriced or they are trading below their value. So that's one thing. So I will never sell that asset if it still trades below its intrinsic value. Okay. So this is one of the things which I use to determine my exit and my entry. Number one. Number two, I'm not a trader. I'm an investor. So I don't look at daily price fluctuations for me to exit. However, I also have my way to cut my losses. So what I do is, if, let's say I've invested in the stock, and then the prices are going much lower than I expected. So for me, I usually give three consecutive quarters.
Yeah.
If the price will continue to go down for 3 consecutive quarters, then that's my limit to take my losses. Then I have to stop my losses.
Okay.
Yeah. So I say, you know what, let's stop the bleeding. But of course, that is subject to so many other aspects. The potential of the industry, the potential of the economy, where is it heading? Is it just a temporary situation? So we look at all those things. If the industry is tied to the U.S. economy, then we look at what is Trump saying now?
Yeah.
How will that affect that industry all the way here? If I see that there will be more blood on the street, then we cut our losses, and that's where I stop. So number one is the intrinsic value philosophy, which Buffett also uses. Number two is my limit of time to cut my losses. I exit. And number three, definitely, I look at the future potential of that industry. I tell people, let's say like real estate. If you invested in real estate, the previous administration, when it was in power, there was a change of policy and direction of the economy, and real estate was hit bad. But one thing people need to know, if you're a real estate investor, usually the real estate is the industry which is usually the first to benefit if the economy performs well, and the first to be hit if the economy goes bad. That's why if you go to any country in the world, you get off the airport. If you see construction happening, it's an indication that the economy is booming in that economy.
Okay.
If you see the cranes have all stopped and nothing is coming up, it's an indication, early indications for you that something is wrong in this economy. So those are things that, among other factors, that you look at with that industry. So if what happens to real estate in that time, the question was, is it a temporal shift, or is it that the market will never recover?
Okay.
So some people, they're asking me that it's a bust. I say, no. Real estate is not even near the bust, because the deficit that we have as an economy when it comes to real estate is massive, though we're not even close to that. Okay. Yeah. So for me, I said, no, this is just normal cycles in the real estate. So for me, I would not exit my position at that time, because I know it's just a temporal cycle which will come back, which is happening now as you're speaking. Yeah. But if it was the industry which I know is going to an end, and there's no potential for this industry to grow, then definitely I'll come out of that market.
And when investing in real estate, what return would you say is good?
Anything which is above fixed income securities. If I'm investing for return, remember the things which you need to consider before you start investing. Someone else is investing in real estate just to have a stable cash flow from the rental income, regardless if these returns are beating the market returns. So it depends on your objective. If I'm investing for returns, then definitely my decision making will go through that process. Okay, you're giving me 10%. But my risk is higher than in the bonds. The bonds will give me high. So if return is my main motivator, then I will not do that. I will not do anything below that. But if I want to do a real estate just as an asset that I think will give me stable cash flow in the long term, if I'm investing for my own retirement, if I'm building that asset, I can transfer to my next generation through my family trust as intergenerational wealth, then if those are the reasons why I'm investing, then I'll keep it regardless the returns are beating the other investments which have less risk than real estate, and it will give me higher returns than real estate.
In layman terms, what you mean is, let's say if a bond offers you more than 15% and real estate offers you 10%, you personally would pick bond.
Rationally, if I'm looking for returns, a rational person will do that, wouldn't? Yeah, but if you have other objectives rather than returns, then real estate can stand out. It depends on your investment objective.
I'm interested in the family trust that you talked about. What is the family trust and how can it protect someone's wealth?
So family trust is a legal structure which is set up and registered, where the person with the money or with the assets decides to take some of his or her assets and put them under the trust. So you don't put everything, because you also need to leave some behind for your kids to inherit.
Okay.
But you take some of it, let's say 30% of your assets, or 40% of your assets in wealth, or even 50% for that matter. You take it and you put under the trust. When you put under the trust, you appoint someone called a trustee or trust administrator, which I am, by the way. So you put under the trustee or the trust administrator.
Yeah.
So we'll transfer those assets from your name into the name of the trust. So those cease to be your assets.
They're not your asset anymore.
Not your assets anymore.
They're in the trust now.
They're in the trust.
And who owns the trust?
The trust is that's what it's called, a trust.
Yeah.
Those assets are held in the trust for the benefit of the beneficiaries you decide when you are setting up that trust.
So I can put myself as a beneficiary.
You can.
The trust.
You can. Okay. And your beneficiaries, your wife, your kids, some of us, maybe you're taking care of your parents, and maybe when you die, maybe they must struggle. You may also put them, maybe, your spouse and all that. So those are the people that you put in the trust as the beneficiaries.
Okay.
So you have three parties now. You have you as the founder of the trust. You have the trust administrator, who is me, for instance, and then you have your beneficiaries. And my job is to take those assets and invest them, and whatever income which is generated is paid out as benefits to these guys who are your beneficiaries. And you decide what benefits you want them to get. Could be education, could be healthcare, could be startup capital when they finish universities, that kind of stuff. Maybe upkeep allowances for your wife or your grandparents or your parents, whatever that you want to do that. And then there's a legal part where you have the registrar who oversees the legal compliances of whatever that the trust administrator is doing with those assets.
Okay.
So the advantage is the moment you transfer the asset to the trust, number one, those assets cannot be inherited. So they'll never go into inheritance.
Okay.
So nobody will touch them.
Okay.
So if there's one guy in the family who always waits for people to die, so you can go after other people's assets, the moment you go to the trust, say, hey, hell to the no. They're out of touch. Yeah. So that's number one. Number two, if you had a case before you died, and probably you had some bank loan, or maybe you had some court case, and there's an order to liquidate your assets, they will only liquidate the assets in your name, but they cannot touch the assets which are in trust because they are not in your name anymore.
Okay.
So in that way, and the assets which are put into the trust cannot be used to pay the benefits. They must be invested, and the income which is generated from those assets, that's what is used to pay the benefits. So you get what we call perpetuity of assets. So those assets will continue to be there for the rest of the as the world exists.
Who owns the trust?
There's no ownership as such. The trust is now owned by the trust itself. It's the owners. The trust is the assets which are owned by the trust now. Because there's no ownership. The ownership has gone away from you. In the simple language, you would have transferred those assets from your name to your kid's name.
Okay.
But you don't want to do that because the kids can consume those assets and the all assets will go away.
Yeah.
So what you want to do is you want those assets to be used, to be invested, and to benefit those guys. So who will do that? They need to be in a name which is not you, which is not them.
Okay.
Because if it's in your name, then they can be inherited. If it's in their name, they can take ownership and they can sell those assets. That's why they put under the trust, which is a legal structure that puts the ownership in between, but neither in you, neither nor in them, but it will benefit both of them.
Okay.
Yeah. So for us Muslims, if you put your assets in trust, we call it family waqf. The owner becomes Allah, the God himself. And then you are doing all this on his behalf.
If my assets are in a trust and I want to sell them, how does that work?
You cannot. If your assets are in the trust, they are not your trust, they are not assets anymore. You cannot sell them. The purpose of the trust is to maintain those assets in perpetuity, meaning they will never be sold. They'll continue to benefit those beneficiaries. If those beneficiaries, become older, their grandchildren become the beneficiaries. That's how you see the structure as the Rockefeller Foundation. That's what is happening, because they're the trust, structured as trust. That's why today is the 6th, 7th generation still benefiting from Is Rockefeller himself.
How do I control those assets? How do I still maintain the control?
No, you don't have the control, because what happens is when you're setting up the trust, the trust is legally registered. And it is registered through what we call a trust deed, which is some sort of constitution, which says how those assets will be managed, how those assets will be invested, who will benefit, how will they benefit. And that trust, because it's registered in Tanzania, for instance, is registered under REITA. So registrar of REITA makes sure that the trusted administrator that you appointed behaves with those assets. That's why before they do anything with those assets as a trusted administrator, you must get a permission from the registrar before you deal with those assets. Yeah, that's number one. Number two, when you're setting up a trust, you also set up what we call a family council. So a family council becomes some sort of a board where all the beneficiaries and you as a founder meet with the trusted administrator either once a year or twice a year to see what is he doing with your assets.
Okay.
To make sure that he still behaves. So even if you die, those beneficiaries will continue to have sessions with the trusted administrator to see how those assets are managed. So there's still some sort of control, but not direct control in terms of giving directives on how you want those to be used. Another thing is when you're setting up a trust, apart from the trust deed, you also set a document which we call an investment policy, which will guide the trusted administrator where to invest the money. So it's not the discretion of the trusted administrator to invest whatever he likes or she likes. They will only be invested based on the investment policy, which you approved, which they also know. So if I want to make any change in the investment policy, I must bring it to the family council as a board to approve it, whatever that I want to make a change on that investment policy.
Who decides who are the beneficiaries of that trust?
You, the founder.
Okay.
So when you're setting up that trust, you tell us who do you want to benefit from the trust.
So the founder of the trust only has a say when
setting up the trust.
After that,
kaput, no more.
Okay.
The only thing we can do while you're still alive is to change the trust administrator. Because don't forget, the reason why your assets are protected, they cannot be inherited, they cannot be liquidated because they're not in your name.
Okay.
If they are still in your name, and then the court will go after them, they'll go into inheritance. Even if you say you set up a will, let's say if you're a Muslim, your will can only protect 1/3 of your assets, according to the inheritance laws in Islam. So you cannot put everything under your control. But the moment you transfer the ownership, then that ownership ceases from your name, now is in the name of the trust. But that trustee is not the owner, is only a trustee, holds these assets for the interest of who? Of the beneficiaries, that you want to benefit from those assets.
How much does it cost to set up a trust?
No, there's no threshold. Apart from just normal cost of setting up, maybe pay the lawyer, pay us, pay the registration, which is just common stuff that the cost will incur. Then you can start with you just need to have an asset to start with.
And as a trust administrator, how much do you charge to manage the trust, and who pays you?
No, so usually under trust, you set up a trust, and then the income which is generated from the investments, you set aside the cost of managing that trust, and then the net income is what is used for the beneficiaries. So the cost of managing the trust is what you pay the trust administrator.
Okay.
So the trust administrator, well, we like myself, we charge a management fee, which is usually 2 to 3% of the total value of the trust.
Okay, let's say I have a trust and I pass away. So I have to list people who will be trustees after I pass away.
No, you have two options. You can list the names or you can list the criteria.
Okay.
And then the family council, which is attended by your representatives who are your beneficiaries, will appoint the next trustee.
Okay.
Yeah, if you want to remove him or her. Yeah. So it's good to put criteria rather than names, because names, people die, yeah, or people change.
Okay.
And because at the end of the day, you want someone as a trustee, not just because someone has the technical capabilities to do that. You need someone with the right track record. Their behavior, the people that can have a relationship with other people. So there's a lot of criteria rather than technical that you need to make sure that you put it into the TOR of hiring a trust administrator.
So how does corruption impact investments in Tanzania, and what steps can be taken to mitigate that risk?
No, corruption can only be used, can only appear in the investment circles in scenarios which are very limited, honestly, because the process of investment is very straightforward,
yeah,
and very transparent, by the way. But it can happen, let's say, for instance, I'm just talking of the scenarios. It's not necessarily happening in Tanzania, that you want to list a company at the Islam Stock Exchange.
yeah,
So you can sell shares to people and people will invest in your company. But you don't have all the requirements for you to get listed. So you bribe the capital markets authorities
no,
to overlook some of the requirements and to get you listed in the stock market.
yeah,
So as a result, the company which will be listed won't have enough, requirements for it to be listed, and it becomes now a risk investment for people to invest in at the end of the day. So that's one of the scenarios where I see corruption can affect investment as an industry in its totality, or like in the trust, for instance.
yeah,
Maybe the trustee gets approached by one of the beneficiaries, and then they decide to make some changes in the investment policy, whatever that they want to do, some of the things which the founder didn't want, because they know if it happens, the trust administrator and one of the beneficiaries will benefit. No, those things. And then, of course, because for you to change that, you have to take it to the trust Administrator General at REITS. We also needed to bribe those people. So those are the only areas which I think corruption can come in. Otherwise, it's a straightforward business, and each one benefits from the transactions. If you come to me, I won't ask you for a bribe.
Yeah.
Why should I ask you for a bribe? Because you're coming to me to invest your money. I'll charge you a fee.
yeah,
And then I go straight to the market and buy stocks for you. There's no any scenario for us to, unless maybe someone bribes one of my staff, and then maybe they do some hanky-panky stuff, which is very less likely. Yeah.
What's your favorite book on investing?
Wow. My favorite, which I usually tell people is like a standard for people to read, is The Intelligent Investor by Graham.
Okay.
Yeah.
You personally, you're an author, and you have written several books like Dare or Die or Smart Up Your Startup. What motivated to write these books, and what are the key messages that you hoped the readers will take out of this book?
Okay, so Dare or Die is called Dare or Die, the courage to pursue your dream.
Okay.
I wrote the book from my personal experience.
Okay.
That I was employed once, and I decided to take a risk and start my own stuff.
Okay.
And I feel like there are hundreds, if not millions, of Tanzanians out there who would wish to do what I did, but they're scared to do that.
Okay.
There are so many people who are employed, they would wish to start their own stuff, but they still have that fear.
Okay.
So Dare or Die simply means dare to go out, do your stuff, and the growth is unlimited, or stick there and do the things probably you don't like, you hate, but you have to do it. That's what the die part means. Probably you want to grow, and that becomes your. And I don't say necessarily that everyone who is employed is not happy, they should quit. Not necessarily. I'm specifically referring for those who would want to quit and start their own stuff. So that's the message I want people to have. You know what? Go out and do your stuff. As long as you have some way of you mitigating the risk. So that's the message that I was trying to send across. Smart Up Your Startup, the book was purely based on the experience of my work. When I started consulting, then, because SSC Capital started as a pure consulting firm, not as an investment bank that we are building now. And when I started then, my target was small businesses, startups, SMEs. And I came across a lot of challenges that they are facing. And you come with your business, the challenges which I see you have 60-70% pretty much similar to some of the challenges which the next business owner will come to me that I would see. I say, okay, it looks like most of these challenges are very common. Financial management, strategy, staff, human resource, very common. So maybe, and I cannot get access to serve everyone in Tanzania who has a business. Maybe I can write a book and put most of these experiences and the learnings that I had with my clients, put under the book, that whoever that wants to start a business will know how to start the business with the right footing. That's why I call it Smart Up Your Startup. When you are starting up, make sure that you are smart enough not to make the mistakes that majority of people do make. Yeah. That's the whole idea of the second book. The third book, which is out of circulation now, we published. We had some few mistakes in the book. Is called Where Is the Money? And the idea was small business in Tanzania, startups, great ideas, interesting entrepreneurs. They want to raise money, but they don't know where and how to do that. Yeah, so some people go to raise money at a time when they should not. Some people go to banks why they should not. Some go to venture capitalists, which they should not. Because funding has a cycle from what we call pre-seed to growth. So there are stages and there are different types of financing. So I just want to write a book. It was more of a guidebook rather than just a traditional book to guide people who want to go into businesses to know where to raise money, how to raise money, the questions you asked me earlier, what sort of things they need to have, what is venture capital, how does it work, what instrument are they using, how do banks work, what do banks look at when you're applying for a loan, how can you manage bank loans. Those are the things which I wanted to. So it's a book which will come out maybe next year, hopefully, shall.
And how do I get these books?
So Dare or Die, we only published the Kindle version. So there's no hard conversion, so you can buy it on Amazon. Number two, Smart Up Your Startup. Again, there's a Kindle version, which you can buy on Amazon. There's a physical book, which you can also buy on Amazon, and we can also sell it from our office. Initially, we were distributing through the bookshops and other distributors, but they're not paying us our money. So I decided to cut that off and keep all my books in the office. So if one wants, you just call, and it gets delivered to wherever you are.
Okay. And you do a lot of stuff. You are an entrepreneur, advisor, you're an author. So how do you manage to balance your time in all of this? And as I said previously, you're one of the very few guests who came here on time. So how do you manage your time to maintain the productivity that you have?
Wow. First of all, I think, again, you asked the question of myth. The work-life balance is the myth. The myth, if you ask me. Always one must suffer at some point. As you grow, probably, and you become bigger, then you can have less time at work. You can have more time with your life. Yeah. But when you're starting up, there's be less time with your life, and there'll be more time at work. It's as simple as that. So how do I manage? I think it's just planning. First of all, I'm a very disciplined person. This is one thing you should know. Next time you call me for an invite, you should not be here on time. So that's one thing I've built in myself and I've managed. Number one. Number two, I don't have a lot with myself going on in my life. I'm very focused in very few stuff. Yeah. It's about me, home, work, I go to the masjid. Those are the only things that I do in my life. So I'm not an outgoing person. I rarely do that. If I go out, I go for coffee for dinner. That's it. So I have enough time to plan and do my stuff. Number one. Number two is I think it's just the way you position yourself on the things that you really want to do with your life. And by the way, one thing which I thank God for me is I'm very productive when I'm working. So I can spend 3 hours and I can give you the work which we might think is a 10-hour work. Because that's one thing which if I concentrate for 3 hours, I can get out a lot from those 3 hours. Because that's the way I work. And again, I can give you my schedule of the day. I wake up very early, and then I start my work very early in the day. By the time it hits, first of all, I don't pick up calls before 9. So everything is about my life between 5 when I wake up to 9, and then I open up to the world after 9. So with that time, I produce a lot. And those are the times that you write a book. Those are the times you write articles. Those are the times you read. And then I'm usually back home 6:37, and I go to bed between 9:30 to 10. So that's how I've structured my life, and it helps me to be more productive in the things which I do. And most of the things which I do are because I do the things which I love. So I can do them anytime, anyhow.
For those who are watching, this, I can say, is the best investing video of 2025.
Wow.
Yeah,
Okay.
because I can say in my time here, we have been talking for 2 hours.
Wow.
I've never done that
Wow.
with any other guest. And as previously I said, our personal assistant prepared questions for me to ask you, but
Yeah.
I didn't ask none of those questions. So
Yeah.
that means if people want,
Yeah.
we can come back for part 2.
Okay.
So if you want Mr. Salum to come here for part 2, just comment down below. Mr. Salum, go to his Instagram page and beg him to come back here. And there are a lot of stuffs that we need to talk about. Even me personally, I haven't finished my question, but I think right now the time is not on our hand. But if you want him, as I said, comment down below, Salum Awadh, and he'll be back because we have a lot of things to talk about investing and stuff like that. So with that being said, finally, we have a tendency of asking the guests before you leave, what do you have to say to the audience that you think will be beneficial?
Learning. As they say, the best investment you can do is to invest in yourself. I tell you, it always pays. I can tell for a fact I've been invited to tables which I wouldn't if I didn't have certain type of education. I've gone to places just because I had some knowledge that gave me the ticket to go to those places. I've secured some things in my life because of the knowledge that I've built. So I strongly call upon people, advise to not stop reading. Learning and reading. Buy books, read at least an average of 1 book a month. You have your 12 books a year, massive knowledge, I can tell for a fact. Let's spend our time properly online. I think there's a survey which said Tanzanians spend an average of 7 hours on social media a day. What sort of things are we doing online? I don't say you should not get entertained. I don't say you shouldn't have your own me time, but make sure that every time you get access to all these tech, digital tools and everything, your phone, your laptop, learn. There are a lot of knowledge out there which is for free. YouTube, on Twitter, follow the pages which will give you a lot of knowledge, insights, or the things that you want to do. So for me, I think learning is very important. And learning comes down to pick one area initially and then go deep into that thing. Learn so many about that subject that when they are looking for 3 people in a country about certain subject, your name should pop up. And then you can start learning about other things. Of course, we try to learn so many other things after some time. But initially, make sure that you become an expert in some subject. Learn so much about that. Do some certifications if you want to. Attend some conferences. Those are things we do. And then you learn so many things. And then I tell you, the knowledge is power, as they say. And you see the difference and you thank me later.
As you said, knowledge is power. Even I myself today, I've learned a lot of things. I didn't know nothing about family trust. I didn't know nothing about Islamic bonds. There are a lot of stuff that I didn't know. I didn't know investing in the Tanzanian market. I didn't know, but today I'm here. I have learned. Hopefully, you have learned as well, the one you are watching right now. And comment down below. What have you learned so far? And if you have any questions, because there are some topics here that are very difficult to understand. Even myself, I was using a lot of my brain to try and keep up with you. So if you haven't understood anything, just comment down below. I'll personally take those questions to Mr. Salum Awadh, and then we'll discuss together, because the aim of this podcast is for us all to grow together and make our own destiny through providing value to you guys. That's the problem that we're trying to solve. As I said, you don't invest in anything that does not solve a problem. So basically, we are trying to solve a knowledge problem so that people will understand about investing, business, and stuff like that. So with that being said, thank you, Mr. Awadh.
Thank you.
Yeah, for coming today. We appreciate for your time. And for the one who is watching, please like, subscribe, because if you love us today, you'll love us more tomorrow. And thank you, and see you on the next one.